We did that before. Let's start at the beginning.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker and registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying a guarantee of any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. That was great. All right, how's it going, guys? Let's see, what is going on in the market at the moment? We've got, been in and out of silver a lot, and I got my basis down to 1685 on 3 contracts. So overall, up about $700. I keep whittling it down. I mean, we started at a higher number. I don't even remember where we started, but we start at a higher number, and every time it goes down, I add a couple, then I sell a couple, then I add a couple and sell a couple. And what happens is the core 3 that I have end up getting a lower and lower basis. So, you know, at a certain point, it gets low enough where hopefully this will be low enough where it'll go over 16 or it'll go back over 17. I'll be all relaxed. I don't have to worry about anything to even stop out unless I have to stop out when it goes over under 17. That's how you take advantage of the really big runs, is because, you know, you have a really low base, so, you know, you can set your stops nice and wide on the way up. Oil, bottoming out yesterday, got back to 48.50, went a little higher, but, you know, 48.50 is where we thought it should be, so that's fine. Gold is drifting around 1,200, and that obviously if gold goes higher than 1,200, that's good for silver. The dollar is gasoline. Gasoline is 158 right now. We were playing it when it was down here, but we're not too interested here. If it comes back down to 156, I'll be interested again. I mean, gasoline has had fairly steady demand. In fact, we're going to take a look at that in a minute. First, we're going to look at the dollar. Okay, see, the dollar just dropped considerably today. I mean, 0.2%, but 0.2%. I mean, that's enough to pop the index at 0.2%. Shit. Stupid town telling me whatever about the snow again. I think they called about 25 times. The automated systems in the hands of politicians are really dangerous. What were we going to look at? I forgot now. Well, oh, yeah. The index. What the hell? I'm not scanning. Charts. So we just hit 5,400 on the NASDAQ, and you can blame Apple for that. Apple just, should we put where Apple belongs? Replace the Nikkei from it. AATL. Apple just flew back up to 140. So that's part of what's going on over there. NKD again, okay. Oops, not KD. NKD. Oh, damn it. There. Oh, yeah, I need some AI. All right, anyway. I don't know what this is about, other than the dollar dropping a bit. I mean, because, it's only up 0.2%. So, honestly, that's what the move is from the dollar. The Russell really popped. Look at this. This is, 1350 all the way back to 1373. That's a big move. This is a really tempting short right here, 5,400. But, the Fed's coming in an hour, and it really is a bit of a wild card, though I'm conceptually leaning short. I think there's nothing they're going to do or say that's particularly encouraging at this point. I mean, they've got to tighten rates. They've got to prepare for more tightening. And if they say they're still worried about the economy, but see, here's the thing, even if they say they might not tighten rates, they're going to say they're more worried about the economy, even though they have to tighten rates anyway. That's not a good sign. I'm not sure what kind of positive message they are going to really be able to send out of all this. I mean, they have to tighten rates. And they have to tighten rates mainly because, God forbid, anything does happen, they have nowhere to go. You have to have an interest rate higher than 1%, and we're not even at 1%. You have to have an interest rate of 1% in order to be able to cut a half a point in an emergency. And honestly, what's a half a point cut going to do for anybody anyway? So, honestly, I don't see what the big positive thing is going to be out of this. And we've been waiting for a correction anyway. I just think this is going to be a good excuse for the market to sell off a bit. So, futures-wise, tempting. It could be fun to take the short trade. It could be a big thing. But I can't see doing it. The risk ahead of the Fed is just a little bit kooky. So, on the whole, I think basically I'm just going to sit out and watch from the sidelines, except for silver. I like my silver. I think we talked about. We talked about silver because silver was. Let's take a look at this chart. Metal, silver. So this is daily. So here we are on March 1st. It was over 18. Now it's under 17. Okay, it's basically 1850 here. So that's a 10% drop. So we're completing a 10% drop. And what happens when we have a 10% drop, kids? Right? 1850, nosy, right? Which is fine. We like that when it comes off a nice solid resistance point. How did it do last time at 1850? It went over a bit. Here it collapsed. Here it stopped at 1850-ish, failed, went back. Here it went up to 1850, came through it, and look at that breakout over 1850. Went nuts. And this is only July. This is like last year. Then, down here, we tested 1850, popped back up. Here we fail 1850 in a nasty manner. That's all in one day. Then, back up, and out to here, testing 1850. So, certainly 1850 is a significant line. 17 is a significant line. All right, probably it's probably 16, and then whatever 16 plus it's 17. 16 plus 10% is 16, 17, 60. Let's see if that makes any sense. Yeah, see how that's 1760 over there, and over here, and over here. So yeah, I think 16 is probably the real line on silver. So if we go to 1760, and then half of that, which is 15%, is 80 more cents. It's 1840. So that sounds right. So basically, we're looking at like a 10% move and a 15% move. So if you're going to draw lines, you want to draw a 10% line here to 1760, sorry. And then the 5% more line would be 1840. And above that, you'd be at 1920. And then above that, you'd be at another 80 cents is 20. So that, and there you go. I mean, so basically that's what we're moving in. You're basically looking at the range from 16 to 20 is a 25% gain off of 16, and all the lines in between are significant for this. And if we drew that out, it would be pretty obvious that that's the right range to be playing on this stuff. In fact, you can do that. I never tried this before. I hope it doesn't explode the entire system. because this thing lets you draw stuff. So if we went to silver, just to give you an idea, and we go to the closer looking chart. Oh, actually, that was my bad. Let's use the weekly chart. There you go. Is this weekly? No. Daily, weekly, update. Okay. So now if we take, oh, then I got to annotate it. Hope you guys are still there when I'm doing this. Then there's a tool, which is a Fibonacci tool, that thing. Fibonacci retracement, there we go. And now we start at 16, and we go up to 20. There you go. And you see how well those lines fall in? It's not the same as the 5% rule, but it's similar the way it works. It's a similar concept. The 5% rule is not that different from Fibonacci lines, except that because the Fibonacci rule is looking at is more based on nature and the way things behave in the natural environment. The 5% rule is taking the same concept and saying, well, if we apply this to computers, computers don't make natural moves. They make moves based on sequences that are based on other factors. So, but conceptually the same thing. We draw lines just like the Fibonacci lines, and as you see, though, the Fibonacci lines in this case work out pretty well, and you can easily see where your supports and resistances are. You can see 1850. If I see in the 5% rule or in the Fibonacci rule, 1850 matches up, and so does 1795, 1748. So basically, it's the same exact lines we were just talking about on the 5% rule. So that's our trading range for silver. So as we get towards the bottom of the range, I like buying it because I got, if I'm not going to make an accumulation down here, when the hell am I going to buy it? I don't know that we're going to get back to here. See now, if it's an up trend line, like see this line here, if the trend line is generally going up, even if it's the lowest part of the line, oh wait, I can draw a line. I feel like such a professional. Trend line. Okay. Look at me, I'm like a TA guy. All right, and then we go ahead. So even if we draw the line here to the bottom of this guy, what do we got? So I don't know that we'll ever hit that again. So I can't just wait for it. So I've got to start buying a couple here and there and try to work my basis down to my goal, which would be about 1650. Because I don't think we're really probably going to go under 1650. I think that line, given the fact that we've had time to build a more of a base, that line is more likely to hold there. All right, so you got it. So anyways, that's why we're accumulating. That's why I like accumulating silver here. I think we're generally in an uptrend. And of course, and then you've got to factor in, if you're going to really do this properly, you then have to put a chart of the dollar next to it, which I don't know how to do. But I mean, other than I do it on another screen when I want to look at them. But you put a chart of the dollar next to it, and you compare, like say, okay, well here we spiked up, but that's because the dollar did this, and then the dollar did that, and that's caused us to punch back down. And so if you take away that noise, you'll get more of a normal sort of trend line that's probably showing this is at the very low part of an uptrend that we're in, discounting for the dollar variances. All right, but again, it's not about TA. It's about what we think is the value of silver. Wait, save changes? No. Okay, fine. It's about where we think silver should be, and silver should certainly be more than $16. It should be more. It should be more than the middle of the range here. Okay, and it's being kept down by the stronger dollar. Oh, well, here I can do it. All right, so see here, 1650, or we said 16. 16 is the line for silver, right? So basically, it's kind of hanging at 16, whatever, right? Now, if we do the dollar over there again, we're going to be in the same 2-year thing. USD, I think it is. Yes. So in the same range of the dollar over time, we're basically a bit stronger. And not a small bit, it's like 10%. So the 10% move up in the dollar is what's putting pressure on silver over the long haul. But silver's pushing up, but it's being slowed by the dollar's rise, especially, remember that July period, right? Especially since July, when it went up from 94 to 103. It's been a big push that's hurt silver over here. And we had a little pullback and a little up, but it's not the same as this big move here. I'm going to go back to silver now. And here we are. So there's a 10% move in the dollar caused a 20% drop in silver. So it's almost like a 2 times effect. Then it comes up a bit, then down a bit. So it's basically kind of following the dollar as it's going. So now we have the Fed, and if the Fed, again, I think that the dollar is strong at the moment. I think the reason we're seeing this is because of the anticipation of the Fed tightening, and therefore 104, 103. But, also the euro is falling apart. I mean, the euro is really losing a lot of confidence, and now the Netherlands is talking about getting out, and Turkey's having a fight with the Netherlands, and Scotland wants to leave England and go back in the EU. It's a complete mess. And Le Pen is leading in the polls in France, and she doesn't want to be in the EU. It could turn ugly. Greece is still Greece, and Italy is going to be Greece in the near future. It's not good. So the entire thing may fall apart. Now, if that happens, the dollar will become quite a bit stronger. We can see 110 in the dollar if the euro completely collapses, but it won't happen overnight. It'll take years to unwind. That is a factor in the dollar. And frankly, if it wasn't for the euro, having problems, we would be a lot weaker now. But that's already part of the dollar's valuation, is that nobody really, there's less trust for the euro than there should be, given all things being equal. My ideal range for the dollar is really about 100 to 103. I think that's where we should be generally in the dollar. This Fed announcement, though, should push us up in the 103, maybe even to 105. We'll see what happens. But a lot of it's baked in, so maybe we're going to top out at 103. And if we do, then silver and gold both have a lot of room to run. And gold being at 1,200 right now. Whoa, what happened here? All of a sudden, question. Eric starts us off with a prayer, very nice. When the left times everyone hears sound. How do I get those lights? Those are pivot points. Yeah, there's a study. If you right-click on the chart and you go to studies, and you say add a study, and then you say trend studies, and then you go to P, you have pivot points. So that's it. And that's all it is pivot points. I use that, and I generally use I think it's a 3-day, I don't know. I think I use a 5-day, 5-minute chart as my standard view. Pretty sure that's the one I use for standard views. And again, that's just something you set, because you go to the thing, and you say chart scale, no, not chart scale, sorry, style, and then you go up here, intraday, 5 days, 10 minutes. And when you like your chart, you go to style and say save your style, and this style is called I call the style a 3-day style. I call it 3 days because all I can see is 3 days. I can't see 5 days. I can see 3 days. I guess if I made a wider box, but to me it's a 3-day chart, but that's what I see on the screen when I look at it. But anyway, you name the style whatever you want, and then when you want on each chart you click on, you just say style and then load your style, and then it'll set up exactly the way the previous chart was, or the one you saved, which is actually really good when Thinkorswim reboots themselves, because they can be really annoying when that happens. Oh, look, we're selling off. Oh, well. That's pretty funny. All right. On the bright side, though, silver should be doing good. Yeah, 850. Okay. Not bad. Yeah, so sorry, we're not going to have any good futures plays today. I mean, we'll take a look when the Fed makes their announcement, but it's such a dangerous time to play when they're doing this kind of stuff. Can you lay the thing up? No, I can't. I mean, maybe you can, but I don't know how to do that stuff. I don't get. I don't generally use charts. It's just illustrates a point, basically. You have some red horizontal lines, and yeah, those things. Okay, the pivot points. I guess we'll talk about. Should confirmed rate hike put downward or upward pressure on oil? Again, I think that given my concept of a range for the dollar, and I've been pretty damn accurate all year, and being that we're at the close, we're in the middle of the range. We're 101.50. I don't think it's 100% baked in. I think it depends on if they indicate. I think 3 rate hikes are now expected. I think if the Fed kind of indicates there may be a 4th, that might push the dollar a bit higher. But I still don't think we're going to go much higher, and therefore I don't think that's the villain for oil. Oh, we should look at oil. That's a good thing. We'll look at oil next. So I don't think that's – look, oil's pressure is coming from, first of all, way too many contracts. We talked about that in chat this morning. Did I do that? Was it this morning or last night? I think it was early this morning. Oh, yeah, right there. Okay. So, here's the problem for oil. You see this? Keep in mind they don't actually want these barrels. That's 247,000 open contracts for April delivery, and the way the delivery thing works is that it's the 3rd calendar day. So before the 25th. So the 3rd working calendar day. So if there's a holiday, you skip it. But so 1, 2, 3. So basically the 22nd this month is the delivery day for oil. So if you have an open contract at the end of the 22nd, you will be collecting these barrels of oil. They will be shipped to you. Well, not to you directly. They'll be shipped to Cushing, Oklahoma, where you're responsible for all storage, transportation, etc., until you sell them. That's not good. Okay, if you're not actually an oil dealer who actually needs physical barrels of oil, that's something that can mess up your whole month next month. Or you give it to somebody who's going to rip you off and charge you a huge hit for taking it off your hands, which is, so you never want to go into it with these contracts. So nobody really wants 247 million barrels of oil to be delivered in April. They're fake orders. All they are is just to, run the NYMEX up and down. That's all they do with it. So by next week, there will be probably less than 14 million barrels remaining that are actual real orders in April. So 230 million barrels of oil need to be shuffled around. They're going to stick them in these months, but these months are already pretty bloated. You've got 500 there. You have 300 there. That's 8. That's 9. That's 10, 11 and a half. So this is 1.15 billion barrels of oil on order in the front 4 months. That's a big number. We don't usually go over a billion, and even when we're at a billion, they're very tight in supply. So they've got a huge, huge problem here with way too many barrels on order. And they have, let's count today, 1, 2, 3, 4, 5, 6 days. They have 6 days to get rid of them. So they got to dump about 40 million barrels a day. So we're going to watch the progress. If they get ahead of themselves, that means there's less pressure to the downside. If they start falling behind, if they have a bad day and only get rid of 20 million barrels, that's going to put a lot more pressure to the downside on another day. Because every day the pressure mounts to dump these barrels. So that's what's going on there. That's the biggest factor between now and next week. That's the biggest factor that's affecting these guys. So anyway, the rate hike, I mean, obviously there can be nothing but downward pressure if the dollar goes up. That's going to put downward pressure on. How do you grow into some money? I must be asking the basic question. Right. Can you change the time frame? You can change the time frame, but I'm very against, when you're doing technicals, I'm very against changing the time frame because the whole point to me of doing a technical is that I want to see what other people are going by. And so I don't want to customize technical that I'm the only one using it. I want to see what other people are going to do. So I like to use the standard ones. Oh, I didn't know that, Billy. Thanks. If you lose sound, click dial in and click listen only. Interesting. I never knew that. What was the fundamental case for silver? Fundamental case for silver is, first of all, it's an industrial metal. So if the global GDP is picking up, if manufacturing is picking up, they use silver for many various things. Also, it's a hedge against inflation, and it's been fairly underpriced, especially compared to the rise in gold. So when silver's down around 16 and gold's still over 1150, I like to play for silver to go up. That's all. And just overall, generally, we expect inflation down the road. Assuming the economy does actually pick up and doesn't fall apart, which it seems to be doing. We seem to be building strength inside, like real strength is coming. A lot of it is wage-based. The wages are starting to rise. Unemployment is low. That means there's more money at the bottom of the economy that moves through it, and as more money moves through the bottom of the economy, you tend to get inflation. And so and any kind of inflation is going to be good for silver and gold in the longer term. So it's not a case like I think tomorrow is going to do this or that. I just think over time it should be more like 18 than 16. Therefore, when I'm close to, anytime I get close to 16, I want to start buying it. We expect more rate. Yeah, we expect more rate increases, but they're not big rate increases. They're little quarter-point increases, and in as much as they turn out to be ineffective in fighting inflation, if the Fed starts tightening, you still see inflation. That's going to give the bulls of gold and silver a big onus to buy more. They're going to say, "Oh, this inflation isn't going away." Only if the Fed tightens and you see inflation immediately pull back, and people start thinking the Fed has inflation under control, that's when you might see a difference. That's when people might lose confidence in gold and silver. But I don't see that happening, frankly. And again, silver has that nice industrial component to fall back on. April oil contract down 232. Okay, well, whatever. But the point is, they have 6 days to get rid of it. So every day we got to watch it and see where they're at. I mean, obviously during the day they're going to be getting rid of some of the contracts. That's how it works. What happened here? Yes, I think too many open contracts. I think there'll be downward pressure on USO. We're looking for the bottom in next week, and we want to then go long on oil. Because going long on oil into June or July is generally a no-brainer. It just happens so often that it would be silly to bet against it, and so it's just worth the toss. Even though I think fundamentally, look, I don't think it's going to go high. I think 60 is going to be the top for oil this summer if they're lucky. 55, 60 is going to be your range for the summer, and then boom, I think it's going to be terrible in the fall. I think we're going to go right back to 40 in the fall very quickly. I mean, it's over. We're in the end game for oil. The same way we've been in the end game for coal for 20 years. It's a slow death. These things don't, when when billions of people every single day are using something, it doesn't just go away tomorrow. There's no quick. You can't say tomorrow no more oil. But over time, it's our use of oil, just like there's still coal. Over time, it winds down and it becomes less and less valuable because you still have tons of coal, but nobody really uses. I mean, yes, you could say, oh, there's massive use of coal here and there and power plants and this and that. It's like, yeah, but it's not the same. It's no longer the primary means of generating energy. Therefore, it's lost its value, and that's what's going on. That's what's going to happen to oil too. It's just no longer going to be. There's so many other ways to generate energy. As an energy generation tool, it's going to lose its value, and it'll become just an industrial tool, like silver. It'll become just an industrial material, and it'll be valued that way, not so much as a thing. And the problem with industrial materials is, if it gets too expensive, the industrial guys figure out how to use something else. And the way we're custom designing molecules these days, that could get pretty ugly. The oil info you're referring to, what is available? The oil info you're referring to, where is that available? Oh, I can't. I got it. I'm not sure. Ask in chat because I'm not sure. Actually, I got to tell you, I'm not. It's on a different computer. Any trade so far on the webinar? Missed until now. No, we didn't do the webinar. No trade in the webinar. Any plays on shale gas producers, which have now become a lot more efficient? I haven't really looked at that, but that's not a bad topic for like the weekend or something like that. Anyway, let's see what we're looking at. Oh, look at silver. All right. I wish I had more of those. Damn it. All right. Well, that's it. That's it. I made $1,000. I wish I made more. All right. Now I have discipline. So in this nice spike up here, I'm going to take one off. So I'm only going to have 2 left. And you have to excuse me. I'll be back in a couple of minutes. I got to go grab something. Sorry about that. I have something done in the house. All right. So where were we? Right on the silver trade. Yeah, that's exactly what I thought. So that was a big pop, and it's something where it is a good idea to take some profits. Almost certainly going to get rejected at 17, so there's really no point in riding out the rejection. Looking at the dollar, see, I think again coming into the Fed, I think I should take this money. $1,500 for a day is pretty good. All right, so let's kill that. All right, there you go. And now we'll see what happens on the Fed. Hopefully the dollar will pop and silver will go back down and I'll get a nice chance to re-enter it. And if not, we'll find something else to trade, right? So what's that? End game for oil? Wow. Ah, it's so annoying to try to keep on track. Chris, if on the webinar. I don't talk about that. Wait, what happened there? Okay, endgame for oil. Yeah, I mean, it's not. Look, it's ending the same way coal was ending in 1950. You know, so here we are 60 years later. It's like, yeah, of course we still use coal, but in 1950 they were like, oh, nuclear power and oil is going to replace coal, and you won't be a major source of power anymore. They were right, but it takes forever. You know, it just means it's not a good time to be buying longs on things. Now, it can cycle up and cycle down. There's no difference. It's just you have to just take in the 100-year view, though, we are winding down our use of oil as a primary energy source. It's going to take decades to play out. But in the meantime, when it gets high, I'd rather err on the side of shorting it than err on the side of being long. So silver's moving up a bit. Odd. Every time somebody puts a new one, it moves. Hold it. Natural gas is the future. Is natural gas the future? That's interesting. I mean, I think so. Look, solar and wind is the future. I mean, natural gas is obviously going to play a big part, but you know, solar and wind, man, when they figure this battery problem out, it's going to become a lot more useful. I mean, everything will just be electric. Ethanol and Betamax, that's the trade to make. Bathroom. Oh, yeah, good. Blockbuster Video. All right, so per latch, you need some silver. That's good. Blockbuster Video is dead. Given peak demand premise, why not long Exxon? We are long Exxon. Ha-ha! Gotcha. We just put that in like the long-term portfolio, didn't we? Oh, no, we put it in the options opportunity portfolio. It's right there. See? Long on Exxon. And I'm sure, I think in the long-term portfolio, we probably have something too. Let's see. What do we have? Oh, we have some Exxon here too. See? Yeah. I didn't know we put it in the we did. Oh, I know what it was. We put it in the long-term portfolio. We decided that was too big for the for the options opportunity portfolio, and then we decided that we would take a smaller position in the options opportunity portfolio because we liked it so much. And it's not even actually; it's actually behind at the moment, so you can actually get in some. Right now, it's cheaper than our original entry, and I guess we don't have any short puts in Exxon anymore, so it's all included in that trade. So where are we? 141. Okay. Given the main one, why long this? Sold TZA 18 calls, sold for 150, now 75. Hope it pops. No, that's not the way it works. First one was March. You only have like a week. No, a week. You have 2 days. It's kind of a weird thing to hope. You should have, I mean, you know, honestly, you should have done something better before that. No, roll them out into a spread. You should always do spreads. I really don't like just naked calls because that's exactly what happens. You get close to expiration, all of a sudden it starts running down on you really fast, and you're screwed. Now, that being said, of course, you might want to, if you want to take a gamble when you wait on the Fed because the rest will just pop tremendously. I imagine you had a nice drop and it evaporated on you. If we pull back again, you'll be in good shape. But again, you know, the danger is if the Russell goes up instead, you're screwed. So, and that's the thing, you don't have time to make an adjustment or anything. You leave yourself with no move. If you have a front month contract and you're not even covered, if it goes against you, what do? You got nothing. You have no value to your asset. Time is a value to your asset. So having longer term calls and selling short calls against them is the way to go. That way you can salvage your money more easily. And the rule of thumb of the spread is if you have a spread that's $1.50, that means maybe you paid $2.50 for the long calls and you sold the short calls for $1. When the net of the spread, not when the net of the spread, when the value of your longs drops from $2.50 to $1.50, which is the net of the spread, that's when you take that $1.50 asset that you have and use it to build another spread in a longer month. That way you maintain your asset value. When you buy a short call, when you buy a long call, you have no asset value. It deteriorates rapidly on you. So that's what it's all about. That's why we sell premium. We don't buy it, because by selling premium, we own the asset, and the asset maintains value for us. And then we can use it to something else. When you pay the premium, you have no asset. You just paid premium, and when time eats away your premium, you have nothing. That's the big difference. Marcia says, Being House, what's your favorite website to use to find the stocks, tag cash on hand and growth? I pay for, so obviously my favorite, I actually pay these guys. What are they called? Stockopedia.com, so stockopedia.com, and then there's a thing called Stock Ranks. And it's a paid service. Oh, no, I'm sorry, stop, that's not it. Sorry. Are we? Maybe it's not these guys. Hang on a minute. I redid my computer. Sorry, I can't figure out. That's not the one. It's more. Uh-oh. Sorry. Oh, no, it is that one. Ah, silly me. Okay. It didn't look right the way I was looking at it. It's Stockopedia, Stockopedia. Sorry, Stock Ranks is a subcategory of them that I was in. They're my favorite one for financial, so I use those guys. I don't know what it costs. It's like not horribly expensive, but it's something I use because I get much better. They do a lot better job. They go further back in time. They got a lot of useful information all stacked up. I also used to use InvestTools. InvestTools was pretty good too, but they kept raising their prices, and I finally said to them, I'm like, you know what, not really worth it. But it was good when I used to use it. I used to really like. In fact, when I used to use it almost 10 years ago, it was by far the best one. But I couldn't tell you what they're like these days. But I'm very happy with Stockopedia, and I'm sure compared to InvestTools, it's incredibly cheap. Oh, I'm sorry. And while I'm here, I can tell you that other thing. Where was it? What happened? There it is. Okay. The oil futures thing is called futures.tradingchart.com. That's where it comes from. And how do I get it? What commodity chart? Commodity chart. I don't know how I get to the other part though. Ah, weird. Oh, I can't get it. Hidden computer. All right. All right. How about slash market quote? So futures.tradingchart.com/market quotes. See what that does. Huh. And if I find oil, what's it do? Oh yeah, okay. And then you okay, so that's what it is. So it's flash market quotes, and then you have to find the thing you want, and then it'll get into the view that I use. Wow, that's complicated. It's a good thing I have all these bookmarks, or I'd never find anything. Oh, hey, thanks, Lisa. That's great. Given peak demand premise, why long on Exxon? Because they're cheap, and just because their business. Again, it's a 100-year decline. We're talking about like decades before this plays out. Plus, Exxon is very diversified. They've got the refining. They're probably 1/3 oil, and 1/3. In fact, I can probably tell you that from Thinkorswim. Hang on a minute. Let's see, Exxon. We'll see where they make their money. What happened? Ooh, that's weird and slow. See this company profile? If you have if it's a big company, you usually get a company profile. I think it's yeah, 30%. See, only 30% of their money comes from oil and natural gas. 25 from petroleum, 15 from natural gas, 13 from chemicals, and 12% from gas stations, basically. So they're very diversified. In fact, all these things, not all these things, chemicals. Gas stations, not so much gas stations, but chemicals and refineries do better when oil is cheaper. So they actually, in fact, make more money, right? Because here's 25 plus 13 is 38, 40% of their business. So they make more money when gas is cheap than when it's expensive. When oil is cheap than when it's expensive. So that's why I like them. They're a weird energy company. But they sell off when oil goes down. They sell off with all the other energy companies. So you get a bargain on Exxon when they get cheap. Plus, they make like $10 billion. They make billions and billions and billions of dollars. They can buy Tesla and start a new business if they want to. Sorry if I miss anybody. It's hard to do this. Guys are hitting me with questions today. CZA 14. Okay. What's the best brokerage firm I can use? I like Thinkorswim. It's not about the for me. It's not about the commissions. Although I'm not. That sounds not so good. It's not about the commissions. It's about execution. You know, for me, I care a lot more about getting good execution than I do about the commission I pay because I can make the money. I'm not worried about making the money. I'm worried about whether or not I get a good fill when I'm making it because people don't realize that. It's like either you say $5, right? So if I'm doing a trade for 10 contracts at $5 a contract, so I'm doing so it's like $5,000, right? And I'm paying my $5 commission. I'm not in this trade to make $5. I'm in the trade to make $1,000. So I don't really care whether or not they charge me $5 in commission, $2 in commission, or $1 in commission. That's not what I care about. What I care about is getting a good fill because if I get a bad fill on a nickel, 5 cents off on 1,000 contracts is $50. And see, that's what traders do not understand that concept. It's like everybody sits there and worries about, oh, am I getting free trade? Am I getting a cheap trade? Whatever. But when you're doing options or even if you're doing any large number of contracts, if you get a bad fill, that costs you 10 times more than you could possibly save on commission. We did have some kind of an agreement with Thinkorswim. Contact Greg at Phil Stockworld because we used to have an agreement. I don't know if we still have a rep anymore. They changed since TD Ameritrade bought them. But we used to have our own personal rep and everything, so I'm not sure what happened to that. Do you like REITs? They lose out. Yeah, REITs get unfairly beaten down when rates are going up, and you have to just pick and choose the ones that have proven that they're good at handling rate increases. Now it's hard to do because it's been 10 years since we've had rate increases. I like NLY. Annaly. I like CIM, which is Chimera, which is another. They have the same management team as NLY. I like those two. We like ARR is another one we like. Who else? I can't think right now. I think we have a couple in the long-term portfolio. Look at, and again, I have with dividend stocks. Here's ARR. NRF doesn't exist anymore, so no. Oh, look, I don't even have NLY. We don't have NLY in CIM because they haven't been cheap in a long time. If they got cheap, I would do it. You know what? We're in these things for the dividend. We're not in it to make money on the stock. So I don't really care what the price of the stock is generally. Like NLY actually is quite good here. I like them at $10. It's not too expensive. We were playing them back here, and when they took off and went over 10, we kind of lost interest. But it's not terribly expensive considering they pay a really good dividend. In fact, let's take a quick look at let's see what they're at. NLY. So paying $1.20 dividend. It's the same dividend they've always been paying. So they're paying $1.20 dividend. It's 11%, which is nice, and that's what you get in the stock for. I just want that steady dividend. Okay, it's a perfectly the PE ratio is 785, which in Yahoo you can't trust it, but it's probably about right. They're a good steady company, and even if they do get a hit, what do I care? I'll buy some more. If they go down to 8, I'll buy more because I want my 11% dividend. And if they tighten it up, I know, the thing is when a company consistently pays, where's dividend.com? Let's try that. Show you. Dividend. I don't know my password if it's in my website. So NL. No, I'm not finding anything. Yeah, I feel everything's locked. Anyway, so if you go here and you belong, you can get a history of all their dividend payments, and you'll see they're very, very consistent, good dividend payers. Oh, actually, you can do this in Yahoo too. You can go to historical data. You can go to show dividends only, and apply that. Oh, no history. Anyway, so look, they're 30, 30, 36, 24, blah, blah, blah. Going way, way back, you'll see these guys are consistently good dividend payers. Oh, I see. It's the time period problem. Let's go back to 09. Done. We'll do that. Oh, there you go. Wow. All right. Oh, I should have gone further than 09. Well, be greedy and go to 06. Okay, great. So, well, it doesn't really say what the stock price was, I think. Maybe it's adjusted. Anyway, so 06, 10, 11, 13. For a while, they were paying 50. They got excited, like before the crash, right? And then even in the crash, they were paying these whopping dividends, 60, 70, blah, 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 right? Then they dropped to 50. Then they come down to 30. So it's been grinding down, but they pay a nice dividend. The stock price ground down too, though. So let's take a look at that. I don't think it's adjusted for any kind of split. We have some charts on the student. There we go. So as you can see, the stock used to be $16. Now it's $10. They pay 30 cents a share now. They paid 50 cents a share here. They're actually paying more now as a percentage than they used to pay. Wait. Well, or probably about the same. Sorry, not more, about the same. But the point being, though, they're a good, solid dividend payer, and they're cheap. Which means, see, now the exciting thing about something like this, and how's CIM doing there in that case? Let me see. CIM, we like CIM better. Yeah, they're in the same shape. And they're down here. So if we go to NLY, we'll stick with that one. Probably add this to the long-term portfolio again since it's so cheap. All about the options, though. If we can get a good price on the options. Now, I like them because I especially like them because they have long options. Not a lot of heavy dividend payers have 2-year options. You can buy them for $10.91, and you can sell. There's the problem. Can't you see? No, that's not worth selling. That's why we haven't. See, there you go. That's why we haven't bought them because they're kind of an in-between spot. There are no 11 calls. Here's 11 calls. You can sell the October 11 calls for 25 cents, which doesn't seem like much, but it's okay because it's only like 8 months away, or 7 months away. So you can pick up 25. So figure you're going to take this. You're going to have the stock for 24 months. So you're going to get 3 of these sales, which means you're going to be able to sell. You're going to be able to sell 75 cents of calls against your stock. That's 7% right there. Also, though, we can go way out in time and sell these $10 puts in 2019 for $1.27. It says of it. You can get more of those. It's $1.20, $1.50. So I would probably go for like about $1.35. And that's going to drop. So if you sell 135 here and 25 here, that's 140, 160. So you're going to end up buying this thing for net $9.30. It doesn't stop you from getting your dividend, and the worst thing that can happen to you on the upside is you get called away at 11, which is no big deal, because you make a little bit of money there, and you would still have the short puts, which still pay you some good money also. And as long as you're not called away, you keep getting those dividends. And I think these guys pay, they do. They pay 30 cents per quarter for dividends. So it's a wonderful way. If you knock your basis down to 960 and you're collecting 30 cents a quarter in dividends, that's 12% a year plus in dividends, just the dividends. Then you've got your call sales. So these are it's a wonderful thing to hold for the long term. And if it gets cheaper, so what? If it goes down to $6, so what? You have a net basis of 9-something, 930, and it goes to 6, so you double down at 6, and now you've got a basis of 7-something. And you're getting 30 cents a quarter against 7. Now you're getting almost 5% quarterly dividends from these guys. So unless something happens to their dividends, who cares what the price of the stock is? So that's why we like those guys. So that being said, somebody remind me that we want to add Annalie back as a trade, because that's a good trade still. Oops, didn't want to do that. FinBiz is free. The FinBiz has a lot of stuff? I don't know. Maybe I'm just lazy. But I'm not talking about screens. I mean, I like to dig deep in the data, not just look at a screener. Oh, the Fed. We forgot about the Fed. Fed raises rates to 0.75 to 1%. And how is the market reacting? Little bit of a pop. Gold jumped up. Silver, look at that. Did I catch those silvers? I did, didn't I? Damn it. So the dollar went down. Interesting, right? The dollar went down. These guys are going up. The Fed forecast 3 rate hikes in 2018. So there you go. That's what I said. So basically, they forecast only 3 hikes, not 4 hikes. So the dollar is now, since at least 3 hikes were baked in, and now we know it's not going to be more than 3 hikes, or in theory, then the dollar crashes back to where back to the middle of the range anyway. There's no reason for it to have gone higher. That then allows the markets to pop, even though there's no reason for them to pop. There's nothing great about this news. And, of course, the commodities get a little kick, too. So everything came up roses. The Nikkei does not like a weak dollar, so it's selling down a bit. And I can't believe I sold those silvers. Oh well. Because now I'm going to have to wait forever to get back in. Very annoying. That's okay. I should just be happy with what I got. All right, do we want to look at the actual statement the Fed made? Do we care? USJ, let's see what they say first. Not so much what the Fed says, it's the interpretation of it. Fed expected, way to be up to date, Wall Street Journal. Okay. Clearly they don't know what's going on. FOMC. March 15th statement. Oh, projection of the material. Oh, man, they got all these materials, too. So information received since the Fed indicates labor market continues to strengthen, economic activity is expanding at moderate pace, jobs remain solid, unemployment rate was little changed, household spending has continued to rise, inflation is increasing in recent quarters. See, here's the key. They really are hyping on this inflation thing, 2%. So if they're going to actually take an action on 2%, that means you can pretty much see when a raise is coming down the pipe, because it's all about the inflation for these guys. I mean, obviously jobs, but so we know. So in other words, now we have a number for the Fed. We can sort of say the Fed says 5% 4.5% unemployment is as good as they want it to be, and 2% inflation is as much as they want it to be. And frankly, anything under 4% unemployment and over 2% inflation, they're going to have to raise rates. They almost don't have a choice when that combination happens. So you'll see how they react. Market-based measures of inflation remain inflation compensation. That's what they always want to fight. They don't want wage inflation. Wage inflation leads to inflation they have no control over. The Fed is actually there. The Fed actually, one of their primary functions is to make sure workers are not paid too much. Consistent with the mandate, the committee seeks to foster maximum employment and price stability. The committee expects that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace. Labor conditions will strengthen somewhat further. Inflation will stabilize around 2% over the medium term. Near-term risks appear roughly balanced. Monitors inflation in view. In view of realizing expected labor market conditions and inflation, the committee decided to raise the target range to 3.25% of the stance of monetary conduct, supporting the blah, blah, blah. It's the same thing over and over again. It's like the same statement. In determining the size of future adjustments, the committee will assess 2% inflation, blah, blah, blah. This assessment will take into account a bunch of stuff. Jesus Christ. The committee will carefully monitor and will evolve, and they'll think about it, and they'll talk about it, and then they'll come up with a statement that will say exactly nothing like this one is. However, the actual path will depend on the outlook as informed by the coming data. Wow. That is scary. Oh, dear. I forgot somebody wanted me to comment on this stuff. Interesting. No, I know that somebody said some reporter was going to call me at 2 o'clock, so we'll see what happens. All right, so nothing. It's a big nothing. And the only reason the markets are popping is because the dollar is dropping. Look at that. See, there with mirrors, right? But boy, we getting a big pop, though. I mean, we're going to act like we're really enjoying this. So this is fine. We're just going to look for another opportunity to short the indexes, which we haven't had in a couple of weeks. So we get a nice pop, and we'll start looking for good places to go short on the indexes. And I'm really missing my silvers now, aren't I? Sold them all? What was I thinking? Oh. I don't even want to think about it. So much money. Oh, well. So there's nothing to really trade on here. It's just a matter of, it popped, and we weren't on that side of the trade, which is, thank God we weren't playing for the drop, right? Because it would have hurt. But I'm very surprised that we're getting such a violent reaction out of the dollar. There was nothing there there's nothing there that you wouldn't expect. Oh yeah, but let's go back to this. Before we looked at this, we saw there was also data. So here's their projections. They're looking at GDP 2.1%. Here's the bad thing, though. Look at this, though. 2.1, 2.1, and 1.9. That's not. There's no serious GDP growth coming along here. Unemployment 4.5 forever, no changes at all. PCE inflation exactly their target rate. Wow, this looks like when Russia. This is like Russian projections, right? Everything was like exactly what they wanted it to be. Core PCE is exactly perfect. Fed funds rate. Now here, that's interesting. This is their numbers. So the Fed is telling you that at the end of 2017, they want to be at 1.4%. They're only at, I think they're 0.75 now. So there's two more hikes here. So they're going to have at least two hikes. I guess technically they're 0.75 to 1%. So I guess if they had two more hikes, they would call that. Then next year, though, it means they need another at least two hikes, maybe three. And the year after that, another three hikes. So they're telling you that they're going to hike and hike and hike until they get back to 3%, which I agree is going to keep a lid on the GDP. So now the question is, when you look at somebody like NLY, getting back to that discussion, is that manageable for them? So how does NLY react to something like this? I would say it's not bad for them. I think they can manage it. And there you go, yeah. So, it's like, because that's not bad. They know, if they know it's going to be three hikes a year, and they can manage all of their rollovers and their interest and all of their loans and all of their borrowings, they can stay on top of this thing, no problem. This gradual, nice up cycle in rates is not going to really hurt the REITs. So you find some ones you trust like these guys, and you can do very well. What you want to look for now, you want to see if the dollar finds a bottom, at which point, here's where these pivot points are useful. You don't usually violate the second one. So that's a bit much. That's a bit much. I'd say you look at it and say that's a bit much. Here you can see the Dow's going to get a little toppy at 20,900. And you can see everybody's hitting these points of resistance, and they're kind of pulling back a little. And I don't see the onus here. I think the dollar is going to stop falling, and you don't have the onus for these guys to keep rising. So they'll make kind of interesting shorts, especially, I think, the NASDAQ, although I want to see what Apple's doing at the moment. Yeah, Apple's kind of running out of gas, so that would hopefully tell the NASDAQ to give it up. And, actually, let's pull back pretty sharply there. But again, nothing with a huge amount of conviction. I'd rather just watch and see what the reaction is over the next day or so and see where we end up. But we shall see. With that approach, Valero is better. Yeah, Valero is good too. We have Valero in the butterfly portfolio. It's a good, steady company. So why not buy SI? I was buying SI. That's the thing. I just got out of it, unfortunately, and I missed that run. Hopefully it'll come back down a little bit. But yeah, that was the premise of buying SI. I gave a whole speech about that in chat today about why it was a good thing to have. If I was able to watch it if I knew I was going to be able to watch it during the Fed, but I would have risked leaving a couple on. But you know how it is with these webinars. I always end up talking, and then I forget that I have something open, and then I lose money. So it should have gone the other way. It didn't. So I missed a nice 10-cent run. That's a shame. It's like $500 a contract. So again, like I said before, I only made $1,500. I didn't make $3,000. Market rally because they found two more hikes. Yes. Well, inflation is close to their goal was low. We were below the goal. It's getting higher. We know inflation's rising. So yeah, it's finally hitting the 2% that they wanted. And also, if it wasn't below oil prices, we'd be well over their inflation targets. They have to raise rates. There's no choice for them. They have to start now. They can't just put it off until it's out of control. Fed inflation close to the target is symmetric yet. NASDAQ's going to take out the highs in the next couple of days. It will pull in the rest of the market higher. I don't think so. I just don't. Valuation-wise, I don't see it. I mean, you can just look at it. You look at it and say, oh yeah, look, that line went way high, so all the other lines should come and catch up. I think it's just ridiculous. It's easy to. I mean, you can spike the market because the Fed's only raising 3 times and not 4. But what does that really do? Oh yeah, see, Fed funds rate range is 0.75 to 1%. So that's why they've got this floaty range, and that's why they can say that it's going to be 1.4% instead of 1.5%. Can you comment on the debt ceiling expiration and how it's going to affect the market? Well, it depends on how it comes. It's not so much that it expires, because it expires and they bump it up all the time. The question is whether or not they have one of those government shutdown fights. If they have one of those, of course, the whole market can tank. It's just, we have so many of these. They raised the debt ceiling, I think, 100 times already. Sometimes they do it without a peep, and sometimes they do it with giant fights. And that's what you got to watch for. Just go watch which way the wind's blowing on that thing. I don't see the Democrats shutting down the government, because then they fall right into that sort of narrative where everyone likes to say, oh, well, they're all the same, right? Because when the Republicans shut down the government, people are like, oh, my God, do you realize what damage this causes and how many people are affected and blah, blah, blah. The Democrats are saying that, and they were right. It's a ridiculous thing. It's like you're having a temper tantrum and breaking everything in the country. So that was crazy. But now the Democrats can't, so on the very thin premise that we're just not going to let you raise the debt ceiling because suddenly we care about it, that's not a good move for the Democrats. So I don't think it's going to happen. I think it'll probably just move. I think there'll be a little bit of hemming and hawing people, and I think ultimately, though, it'll get voted right over. And we're just going to go more and more and more in debt. That's all. 20 trillion? What the hell? I mean, 21, 22, 25. It's just numbers at this point. I mean, I wrote an article a couple of days ago talking about how horrifying the debt is and how the Fed raising rates to 3% on 20 trillion in debt means that we owe $600 billion a year in interest at 3%. 3% of 20 trillion is $600 billion, just the interest payment on the debt. That'll be 3 times more than we're paying now. So that means $400 billion, which is 10% of our government's entire budget, will be added just to pay interest payments. That's a disaster. And I don't know what the end game is going to be. I honestly don't. It's going to be a complete mess. Yellen's press conference could tank it? Yeah, well, I don't know what she's going to say. That'll be interesting. We'll find out in a few minutes. She's going to come on shortly. It says debt ceiling will be increased non-issue unless politics. Yeah, I just said that. Where are we? I can't read anything. He's jumping. Are you surprised CL&R being? No, I'm not surprised at all, because like I said, there's overriding pressure down on oil that's going to hold that market. It's going to be very hard for them to gain ground between now and next week, for sure. So the dollar alone isn't going to do it. They've got problems. They've got this huge contract issue that they're going to have to deal with. And once they deal with the contracts, then they can take it back up. But until they roll those contracts, there's going to be a lot of pressure down on oil. Do I still think silver needs? Yes, I do, because that's a super gradual slope. In other words, okay, let's say there's a 2-to-1 effect of the dollar to silver, which we just observed seems to be about right. The dollar goes up 10% and silver goes down 20%, okay? So if it's a 1% move in rates, even if it bumped the dollar, and historically, you know, the dollar, where was the dollar years ago? That's a good question. Where can I find that out? So let's go back. Let's take the Wayback Machine. No, not that thing. That? No. The charts? Oh, here. Okay, good. Now we're going to go to DX. And we're going to go back a million years. Let's see. 3 years weeks. You can't do longer than 3 years? Oh, boy. That wasn't good. Dollar. Oops. Dollar chart. Time. 1 decade. There you go. Grow the chart. All right, so when gold was flying, the dollar was way down to 72. Gold was $1,800 an ounce. So 72 to 100 is about 50% higher, and gold is 33% lower. So actually, gold hasn't even dropped as much as I wouldn't know what symbol to put for gold. No, I don't know how that goes. Anyway, but anyway, so the dollar used to be so much lower, and gold and silver were up, you know, at higher prices. But now, you know, so silver's dropped about 50%. So pretty much the dollar moving up 50% has knocked silver down 50%. Gold has gone down less than 50% over this amount of time. And obviously, it's been a hell of a rocky road. At one point, you know, gold was, 800 or something like that when the dollar probably, when it popped up here. But that was just, you know, you have to take into account economic collapses, next, and all this other stuff. But the bottom line is the dollar doesn't have that much of an effect on it. And here we're talking about rates. Oh, yeah, that's right. We're going to look at rates. So how about Fed rate chart? $62 years. Holy cow. Okay. So the Fed rates were 5%, and they've dropped 90%, basically. So they've dropped let's say they've dropped 80%. So rates have dropped 80%, and the net effect on gold over that amount of time has been 1,800 to 1,200. Obviously, you know, in and out of the range. But the bottom line is you went from 1,800 here to 1,200 here. So what's the real effect of this? Because all we're doing is continuing this. We were at 0, or basically 0, 0.7. That might have been the low. 0.6, whatever. All right, so 0.6. We were basically 0. Now we're at 7.5, I guess, or 66 according to this. So that's what's happened since 2011. What's happened to gold and silver since 2011? They've gone up, not down. So, you know, you say, you know, there's a short-term correlation where the dollar will move gold and silver very, very directly, but over time, they're going to do their own thing. So it's a factor, but it's not the factor, and just that one thing isn't going to make it move one way or the other, especially gradual. The gradual moves essentially make them a non-factor when you're looking at what's going to happen to these things. So yes, I still like FLW and ADX, and we expected these hikes. It wasn't like it's a surprise to us. So when I made SLW the trade of the year, that was based on the fact that I expected this gradual cycle of rate hike. TLT. What happened to TLT today? That's interesting. What is TLT doing? They shot. There you go. They shot up nicely. See, and again, it's funny because right, you think it would go down. It's too gradual. It's very gradual, and that's what they care about. And that's why we have those 115 shorts, and then it's never going to hit that, not unless something drastic changes, because there's no reason for it. So a rally for the long bonds before the Fed this morning. As you can see, it's not a huge move. As you see, Fed's they're going to come back a bit, yeah, because it's a gradual thing. It's nothing drastic, and that's fine. Actually, the Fed's doing a good job as far as managing what's going on. Yeah, $1 trillion adds up to real money after a while. I mean, we are literally going to be, I'd say by 2019, given what Trump's doing with the frickin', nobody pays taxes who has actual money. We are very possibly going to have a $1 trillion per year interest rate in 2020. That just our debt payment, if we're paying like 4% on $25 trillion in debt, we'll pay $1 trillion per year just to service our debt. It's clearly not sustainable. Yet we're walking right into it. And nobody's doing anything about it. They're not just not doing anything about it, it's making it much worse. And it's going to be, at some point, it will be a disaster. So we'll see. Meanwhile, get as rich as you can, because you're going to need to be flexible. You're going to need that go bag that you can just get out of this country whenever it hits the fan. Brian says, I am sitting on 30 click calls, and I've been selling premium against them currently the 14th. Should I convert to longer dated spread and take some money off the table? Well, I would, yeah. $2 calls. First of all, sell those. They don't do you any good. Why would you want to be selling the money? Regardless of what you have now, it's at $9. So I forgot what year you said. It doesn't matter that much. 2018 $2 calls. So you have short 14 calls. Well, that's obviously fine because it's nowhere near 14. I would sell these because you're going to get, I don't know, at least $7 off. Well, obviously more than $7. If you don't get $7.50, then you get ripped off, right? You should get something like $8 off the table. So I would ask for 8 and see if it fills. So thing number one, I definitely ask for 8. Maybe, 8. So if he's going for 7.30, then he should be 8.30 to 8.50, and he's 9.50. So I would go, I would not even do 8. I would ask for like 8.40, 8.50, and if you get it, you get it. Then I take the money. When that fills, the short Aprils are not an issue. And what I would do is say, okay, look, if you don't want to miss out in case it goes higher, I would just walk away there, frankly. To me, if you got in with the 2s and you have a lot of money profit, I would just be happy with that. Going forward, you could buy the 7s for $3.80, or let's split the difference here. Let's make it $3.50, $4.90 is $1.40. So let's say 70 cents is $4.20. So let's say you paid $4.20 for those, and you sell these guys for $2.30. These are the 12s. So you have a $5 spread. And what do we say you're paying here? $4.20 minus $2.20. So you're paying less than $2 for the $5 spread. So instead of sitting there with your $8.50 calls, you can have a $5 spread that's $3 in the that's $2.50 in the money for $2. You're in just as good a position as you are with your twos, except you freed up like 75% of your cash. All right, so that's what I would do. And then you can still sell calls against it. I would do half sales, not full sales. You can still sell calls against it. And if you want to go really crazy, you can sell these puts too for $1.50, $1.60. Or even sell a $5 put for like 80 cents. That's like free money. That means you net into $4.20. So, there's no reason to tie up all that money in something so deep in the money when you have alternatives that don't require you to have so much cash. Yeah, I did get out of silver. Don't remind me, thank you. All right, and I'll wrap this up shortly anyway. Let's see, charts. Back to the most charts. Look, it's a good day. There's nothing bad about what the Fed did. The dollar is dropping for no particularly good reason. I would take all these big gains with a grain of salt, but it's nothing to react to. You just have to sit back and let the market tell you what it's going to do about it. Let the news spread. Let's see what Europe does. Let's see what Asia does. Let's see what we do tomorrow, and then we can start making some decisions. But meanwhile, this is great. I mean, it's nice if the market doesn't crash. It won't be a terrible thing. There's nothing, the Fed didn't do anything to break anything. And for that, they're being rewarded at the moment, okay? There's no pressing reason to short. I just think that this reaction is too much. And if I were going to do something I would short, I would certainly take the Russell at 1380 as a short, and I would take this NASDAQ at 2380. These are good shorts. This was Dow just got rejected at 20,900. But you got to keep an eye on, we expect, what's the premise of shorting? We think the dollar is going to come back, put some pressure on the markets, and they'll sell off. I'm certainly not going to short silver. I want silver. I wish silver would come back down so I can buy it. But you know what? If silver gets away from me, I would flip to gold. So silver is up 1.3%, gold's up 0.8%. So silver is now outpacing gold to the upside. And just like I think silver is going to go to 18, I think gold's going to go back over 13. So I just have to look and say, where am I going to make more money? What's going to be a better use of my contract money to move from one to the other? So if silver gets away from me, I look to see, is gold there? Is copper maybe? Let's take a look at HG. Well, look at coffee. Coffee came down in price for no good reason. So I like coffee, especially that 140 mark. That's a good spot for it. What do we see? Copper, HG. Nope, see, copper's flying also. So the laggard in the metals, the guy who's lagging the group, is gold. But again, I'm not going to chase it. I don't have any emergency need to be in any of these things. KCN7 is the coffee contract we like, and that's at 143.1. So I do like those. Let's see that for next week. Trade, active. So that's still my favorite, and I think we got out of those. Do we still have them? KCN7. I like the long term. It's the same as with silver, though. I like it long term, but I'm not going to. Oh, shit, it stopped trading. Damn it. It only trades until 1. So, I like coffee long term, but when it spikes up to 145, I take the money. And then it comes back down, and I buy it again and comes back up. Same thing with silver. I like silver. But when it jumps up past 17, I was taking the money, which we just did before. And when it comes back down, I buy it again. I mean, this morning people were arguing me, why are you buying silver? I had an old conversation chat about why I want to buy silver at 1685. So now it's at 1710. I'm not going to short it. I'm just going to wait and hope it comes back down to my range so I can buy it again. And if it doesn't, I'll look around for something else to buy, like coffee or like many other things that we can buy. There's never an emergency to buy something. If you go into it, it's like if you go into a store and they're having a great big sale and you miss it, and you come in and places are like cleaned out, except for like a few things on the shelf. And I'm sure this is happening, something like it. So you go in there, there's like nothing left. All right? You don't have to buy something. You just leave. You take your money and you leave until you find something else you do want to buy. You can't just look at the market and go, oh, my God, it went up. I'm going to miss something. I got to buy something. And you just buy something stupid for no reason. Like, look, everything's coming back down now already while we're talking about it. We want to see what really happens. We want to see the overall actual reaction to things. And there's no pressing reason. If I had, like I said, I don't have a great reason to go short, but if I was going to do anything, I would have shorted those things. Because frankly, I mean, that's more likely. The dollar got too low. It made the market pop. There is nothing the Fed did that indicated the dollar should be going lower or that the Fed or the market should be going higher. It's just more of the same. And more of the same to me means we're still too toppy and overvalued. That's how I look at it. And on that note, we're going to wrap this up because I do have to get back downstairs and talk to these guys. Where are we? Inflation close to go, blah, 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 blah. Okay. Nope, nothing happening. Okay. If you think the SI has room to run to 18, it's a big gain from 1750. I understand that, but I still think it can pull back. I'm not in a hurry. Just because it could look, it could go to 18. It could also go back to 1650. So it's much more attractive to me when it's closer to 1650 than when it's over 17. I have targets for all kinds of things. Apple will be $200. IBM is going to be over $200. I don't buy them unless they go on sale. There's so many things you can put your money into. I don't need to chase one thing unless it comes down. This morning, I made, I don't even know how much we made on silver this week. I mean, we keep making money on silver over and over and over again. Because we wait until it comes under 16, under 17, and we buy some, and then when it goes over 17, we sell some, and it doesn't get out of the range. That's by the way, for recently, not long term. We're here. This whole period here, we buy and we sell and we buy and we sell and we buy and we sell and we buy, and then it wasn't good, but we bought and then we sold just now. But meanwhile, we made more money buying and selling and buying and selling and buying and selling than we made if we made just this one move. And certainly here, you got a much bigger chance of being rejected up here and pulling back to 17. So I'm certainly not going to pay 17.15 when just hours ago I paid 16.85. See, look, that's what it could do too. Very suddenly and for no reason. So I'm really only interested if it's down here where I think we have a really nice base. Up here, I don't see any particular good base here to play off. And again, I haven't read anything that makes me want to play it. I haven't seen, there's no particular thing right this minute that makes me want to buy silver. The only thing that happened is the dollar went down. And the dollar can go back up just as fast as it went down. Like all it takes is one little blow up in Europe or something, and people get pissed at each other, and all of a sudden there. In fact, there you go. There's why you don't play the dollar. There's why you don't buy 17.15. It's 17.12 now. I feel like a real moron, being in that thing and losing money like this. When this morning I literally was buying it for 16.85, and I was in and out like a few times. Patience. Buy things when they're on sale. Otherwise, don't. That is the number one market lesson I can give you. Warren Buffett is the richest man in the world because he waits. It's all about not doing anything until the right time. That's how you marshal your resources, you wait for the proper time, and then you go and take it. Because if you chase after everything, you'll end up with a lot of bad trades. All right, I got to wrap this thing up. I got to get out of here. Anything else? Any important stuff going on? Nope, I think we're all good, and we will do this thing again next week. And I don't have, other than the coffee trade, again, coffee I like is my favorite trade at the downside right now. I will like silver again if it gets back down to 16.85. I will like gold back at 1,200. Oil, I think we're going to have a nice sell-off into next week. Will be fun on Wednesday. We'll see what actually happens as the contract finalizes. But if there is a spike up, I'm not super comfortable shorting at 49. I would much rather see it be at 50, but even up here at 48.76, it's kind of it's much more likely to be a good short than a good long. Now, gasoline, we have been playing long down here. So if gasoline is still down here in the weekend at like 158, 157, we are going to like gasoline long on the weekend because that's a whole different dynamic. So tomorrow, hopefully, we'll get more of a sell-off in gasoline as the dollar comes back, and then we can play along gasoline into the weekend, which is what we usually like to do. Unfortunately, I won't be here on Friday. I'll be partially available because I'm down in Florida. I frankly be very little available on Friday, I think, because I'm sure my family will freak out if I'm like sitting in the hotel room not participating in the wedding stuff. They're funny that way, you know. They kind of think family is important. Anyway, all right, guys. Well, thanks for coming. Have a good weekend, and I will see you all next week. All right, take care. Oh, who has the Q&A? Yeah, that's a good question. Ask me in chat because they're worth looking at. Don't ask questions in Q&A though. I never looked at it. All right, take care, folks.